there's a number that should make you deeply uncomfortable. The median retirement savings for Americans between the ages of 55 and 64, the people who are supposed to retire in the next decade, is $87,000. Not the average, which gets dragged up by the people with $4 million in their accounts, the median. The number that sits exactly in the middle, $87,000. For context, the average American spends roughly $50,000 a year in retirement, which means the median person approaching retirement has less than 2 years of savings. Not 20, not 10. 2, and here's the part that should make you put your phone down for a second. This isn't happening because people are lazy. It isn't happening because Americans are uniquely bad with money. It's happening because the system they were handed was broken before they ever touched it. And today, I'm going to show you exactly how it broke, who it broke for, and why nobody is talking about the part that actually matters. Let's start at the beginning, because this story doesn't start with irresponsibility. It starts with an accident. The year is 1978. Congress passes the Revenue Act of 1978. Buried somewhere in Section 401, subsection K, is a clause that allows employees to defer a portion of their compensation into a tax-advantaged account. Nobody on the floor of the House was thinking, let's revolutionize retirement in America. They were mostly trying to deal with an unrelated tax issue for executive bonuses. It was a footnote, a technical clause, the kind of legislative fine print that accountants read and normal people ignore. Then a benefits consultant named Ted Benna read it, and he saw something nobody else had noticed. He realized this little clause could be used to create a tax-sheltered savings vehicle for everyday employees. Not just executives, everyone. So Benna built the first 401(a) plan in 1980. He meant it as a supplement to pension plans, a little extra savings vehicle on the side. Not a replacement, a supplement. And for about 10 minutes, that's what it was. Because corporations saw something Ted Benna didn't intend. They saw an exit. Because pensions, the defined benefit plans that existed before the 401(a), were expensive and complicated. Under a pension, the company promised you a fixed monthly income for the rest of your life after you retired. Didn't matter how long you lived. Didn't matter what the market did. The company took on all the risk. The company made the contributions. The company was on the hook if investments underperformed. That is enormously expensive when you run the numbers. And corporations absolutely hated it. So when the 401(a) appeared, every corporate CFO in America saw the same thing at the same time. A legal way to transfer retirement risk from the company's balance sheet onto the employee's savings account. And over the next 40 years, that's exactly what happened. In 1980, roughly 60% of private sector workers had access to a pension. Today, that number is under 15%. Meanwhile, 401(a) plans and similar defined contribution accounts now hold over $10 trillion in assets. 10 trillion. The risk didn't disappear. It just got moved right onto your shoulders. And here's where the mechanism starts to get interesting. Because the 401(a) had a second problem built in from day one that almost nobody talks about. It assumed the average American was capable of doing something that professional fund managers with Bloomberg terminals, MBA degrees, and 15 analysts get wrong all the time. It assumed you could manage your own retirement portfolio. Pick the right funds. Rebalance at the right time. Not panic sell in 2008. Not get greedy in 2021. Not withdraw early. Not undercontribute in your 20s because rent, student loans, and the general experience of being alive cost money. It handed a scalpel to someone who needed a Band-Aid and said, "Good luck, don't mess up. Your entire retirement depends on this." Meet Kevin. Kevin is 32, makes $68,000 a year, and contributes 5% to his 401(a) because that's what HR told him to do when he signed his onboarding paperwork. Kevin does not think about his 401(a) because Kevin is busy. He's paying off $34, due zero in student loans. His rent went up 18% over the last 2 years. He drives a 2017 Honda Civic with 112,000 miles on it that sounds like it's having an existential crisis every time he turns left. Financial planning is not at the top of Kevin's priority list. And here's the thing, Kevin isn't irresponsible. Kevin is the median American. And the 401n system was quietly designed around the assumption that Kevin would behave like a rational, fully informed, consistently disciplined investor across a 40-year time horizon, which is the kind of assumption you can only make if you've never met Kevin, or a human being. Because behavioral finance, the field that actually studies how real people make real financial decisions, has spent the last 30 years documenting exactly how badly people handle long-horizon investing. We cash out early. Roughly 40% of workers take a cash distribution when they leave a job instead of rolling their 401 over. That triggers income taxes, plus a 10% penalty, and statistically destroys somewhere between 30 and 40% of what was saved. We invest too conservatively when we're young, and too aggressively when we see markets ripping. We freeze during downturns. We chase returns after rallies. We do the exact opposite of what we're supposed to do, over and over, not because we're dumb, but because we're human. And this is where the gut punch comes in. Because the people who got rich off the transition from pensions to 401(n)(a) SEPs weren't the employees. They were the asset managers. Because when you move $10 trillion into self-directed accounts where individuals have to pick from a menu of mutual funds, you create an enormous, captive, fee-paying customer base. And that fee structure is the part that deserves its own video, its own congressional investigation, and probably its own true crime documentary. Here's how the math works. The average 401(n)(a) charges somewhere between 0.5% and 2% in annual fees, depending on the plan. That sounds like nothing. It feels like nothing. Most people never even look at the expense ratios on their funds. But here's what 1% per year actually does to your money over time. If you invest $5,000 per year for 35 years and earn a 7% annual return, you end up with about $738,000. If that same portfolio charges 1% in annual fees, you end up with roughly $532,000. You just quietly handed $206 to the asset management industry for the privilege of investing your own money. And you probably never noticed, because it never showed up as a line item. It was just baked into the return, silently shrinking your balance every single year. And that's by design. The Department of Labor actually passed a rule in 2012 requiring 401(n)(a) plans to disclose their fees more clearly. You know what happened? Participation in high-fee funds dropped because people finally saw the numbers. Meaning the only reason fee extraction at this scale was possible for so long is that the numbers were deliberately hard to find. Transparency doesn't benefit the people charging the fees. It never does. Now, to be fair, the 401(a) isn't entirely without merit. The tax deferral is real. The employer match, if you're lucky enough to have one, is genuinely free money. And for high-income earners who max out their contributions, invest consistently, and don't touch the account for decades, the math works. Those people are doing fine, but those people aren't the median. And the system wasn't built for the median. It was built around the behavior of the top quartile while being sold to everyone as a universal retirement solution. Here's what you can actually do about it. 1. If your employer offers a match, contribute at minimum enough to get all of it. Missing the match is the financial equivalent of leaving cash on a table and then walking away. 2. Check your expense ratios today, not tomorrow, today. If your funds are charging above 0.5%, find the index fund version of the same exposure and switch. 3. If you change jobs, roll your 401 over. Do not cash it out. The 10% penalty plus taxes will hurt more than you think. 4. If your plan is bad, high fees, bad fund selection, no index options, contribute enough to get the match, then use a Roth IRA for the rest of your contributions. 5. Automate your contribution rate to increase by 1% every year. You will never feel it. Your future self will. None of this is complicated. None of this requires a financial advisor. What it requires is acknowledging that the retirement system you were handed was not designed with your best interest as the primary objective. It was designed with corporate balance sheets and asset management revenues in mind. And working within that system effectively means understanding its incentives, not assuming the people who built it were looking out for you. Because at the end of the day, the 401(n)(a) didn't fail by accident. It failed by design, not maliciously, not through one dramatic conspiracy, but through 40 years of small decisions made by people who were not you, optimizing for outcomes that were not yours. And that's a quieter kind of scam, the kind that doesn't make the news, the kind that doesn't have a villain in handcuffs or a congressional hearing with good sound bites. It's just a slow, decades-long transfer of risk and wealth from people who work for a living to the institutions that manage their money, dressed up in tax forms and HR paperwork and the vague reassurance that you're being responsible. You're being responsible. Just make sure you know what system you're being responsible inside of. Now I want to hear where you land on this. Do you think A, the 401k is still the best retirement tool available even with its flaws? B, the whole system needs to be scrapped and pensions need to come back? Or C, something else entirely is coming? Whether that's mandatory savings accounts, government-managed funds, or something nobody's figured out yet? Drop your take in the comments. I'll be reading through them. Because if the median retirement savings for people about to retire is $87,000, this conversation is already overdue.